Good evening, dear students. Good evening. How are you all? All good? Yeah. Okay, so we were into the chapter of capital structure and we have completed everything, but one last part is pending of capital structure. We will do that first and uh, then we will go for leverages. Okay, so we'll complete the capital structure part first, then we'll take a break, and then probably after that we'll go for the leverages. So we are left with arbitrage thing. Okay. Okay, so MM arbitrage model is something that we have to discuss, or which is Modigliani-Miller arbitrage model. Okay. Now, have you ever heard this word arbitrage word, guys? Have you ever heard this word of arbitrage? Have you ever heard this word arbitrage, guys? Yes. Aware of this word arbitrage? Yeah. Are you aware of this word arbitrage? Yes or no? Buying from low market and selling in high value market. Okay. So arbitrage is essentially uh, taking advantage of price differential taking advantage of price differential of two markets, taking advantage of price differential of two markets to gain profits. Okay, so we are going to take advantage of price differential of two markets to gain profits. Okay, so how is that simply going to happen? So basically, how are we going to take the advantage? We are going to buy it, or we are going to buy in low valued market, and we are going to sell in high valued market. So we are going to buy in low valued market and sell in the high valued market. Okay, so taking advantage of price differential of two markets to gain profits, we are going to buy in a low valued market and we are going to sell in the high valued market. So something of this sort is going to be done in case of company valuations also. Okay, so let us understand how is this arbitrage going to happen and what method is being used and how we are going to use this arbitrage model to explain the difference, to explain the pricing or explain the benefit that we have. So we're going to take advantage of this price differential of two markets to gain profits. Okay, and we'll look at how do we get the gain out of it. Let us say there are two companies. One is a unlevered company and another is a levered company. Unlevered company and another is a levered company. Okay, levered company and unlevered company. Unlevered is a company which doesn't have any amount of debt, right? And one second, guys. Okay, there's some network issue. Yeah. Yeah. Okay. Okay. So there are two entities, let's say unlevered and levered. Uh, so we have equity and debt. So since it is unlevered, uh, So, okay, let's do one thing. Unlevered and levered, since they're into the same line of business, EBIT is going to be same for both entities. EBIT is, let's say, 80,000 for both. From that, since it is unlevered, no interest is payable. However, in case of levered, uh, interest is payable. Let's say interest is paid at the to the amount of 10,000. So we have profit before tax or even profit after tax remaining the same because there's no tax applicable. So PBT or PAT, we can say it is 80,000, and here we have 70,000. Now let's say the cost of equity. Okay. Unlevered is having a cost of equity of 10%, and levered entity is having a cost of equity uh, of, let's say, 12%. Okay. So what will be the value of equity, guys? What will be the value of equity? Hmm. Hmm. Okay. So value of equity is PAT divided by K. 8 lakh and 70,000 divided by 12%. What is the value of equity? Which is 58,333, right? 5,83,000. Yeah. Okay. What's the value of debt, guys? If we have like interest, 10,000 at the rate of 5%. So 10,000 at the rate of 5%. Interest will be, I mean, the value of debt will be, so it is 2 lakh, right? So we get that the value of firm, which is unlevered, that is going to be 8 lakh, and this is 7,83,333. So which of these two companies is overvalued and which one is undervalued? Which of these two companies is overvalued and undervalued? Because ideally, value of both companies, levered and unlevered, should be equal. Ideally, value of both companies, unlevered and levered, should be equal, right? But if I ask you like which of these companies is undervalued and which one is overvalued, so unlevered is a overvalued entity and levered is a undervalued entity. Okay, so as a arbitrager, I mean the investor or the person who undertakes arbitrage, as a arbitrager, which company are we going to buy and which company are we going to sell? Yeah, since it is undervalued, the levered company is going to be taken like a buy position, and unlevered is going to be having a sell. Okay, so arbitrager unlevered is going to have a sell transaction and levered is going to have a buy transaction. Okay. So let us see what happens when these transactions are undertaken. Arbitrager, if it is selling and the other party is going to buy, so what is the reason? If there is there any possibility of gain out of it? So uh, let's assume an investor, right? So let's assume an investor with 10% stake in unlevered. Now he's going to transfer his investment from unlevered entity to levered entity. He's going to transfer his stake from unlevered entity uh, to a levered entity, right? So basically, he's going to sell the shares, and we'll have to see what are the gains and what are the losses are happening, or what are the cash flows happening because of this transaction. Okay, so an investor with 10% stake in the unlevered stake, so is going to take. So let's say step by step. Step number one. Step number one, we are going to say sell 10% stake. Sell 10% stake in unlevered. So what will be the cash flow, guys? If the investor is going to sell his 10% stake in unlevered entity, how much cash is the investor going to get? How much cash is the investor going to get? Can I say it's going to be 8 lakh is the value of equity of that 10%. So basically you are receiving 80,000 as cash inflow. Second step, the second step will involve investing this 80,000. Second step involves investing this 80,000 in the levered entity, guys. So step 2, we are going to take this money and invest in the levered entity. Okay. So you're going to sell 10% stake and invest in the levered entity. Okay. So when we're going to invest in the levered entity, uh, just think of like we had 10% stake in unlevered. If I want to have 10% stake in the levered entity, how much money should I be, you know, how much money should I be really investing for 10% stake? So amount to be invested in. Amount to be invested in levered firm for 10% stake. How much money should we be investing for 10% stake? Because the overall value of the company, I mean, the equity share is what? Value of equity is 5,83,333. Hmm? Okay. Amount to be invested in levered firm, that 10% stake will be 5,83,333. That will be 58,333, right? Okay. So amount to be invested is 58,333. But guys, when you are investing in the levered entity, so when you're going to invest in a levered entity for 10% stake, we invest like 58,333. But when we are investing this, we are essentially also undertaking the risk in the form of debt. We're also undertaking risk in the form of debt, guys. So I need not be only investing in the equity component, but I'll also have to buy certain debentures of the company, because then only I'll have full 10% control over the entity, right? So it's going to be, this is for equity, right? And for debt, it is going to be 20,000, right? So total amount that is invested, total amount that you're going to invest in the levered entity, in the form of the equity shares and in the form of debentures, that's going to total to how much? What's the total figure? 78,333, right, guys? So we got 80,000 by selling 10% stake in unlevered entity, and the amount to be invested in levered firm for 10% stake, it is 78,333. Okay. So that is 78,333 amount to be invested in levered firm for a 10% stake is 78,333 for equity as well as debt. So do we have any surplus cash available with us? What is the surplus cash available? Surplus cash available after investment. What is the surplus cash that we have after investment? Yeah, guys. So this is 1667, right? Okay. Then let us go for step number 3. What was the amount of earnings of investor, in unlevered firm? So when you were invested in the unlevered firm, what was the amount of earnings that you were having? Hmm? What was the amount of earning when you were invested in the unlevered firm, guys? Okay. What was the earnings of investor in unlevered firm, guys? In the unlevered firm. So in the unlevered firm, the firm was having a PBT of 80,000, right? So earnings of investor in the unlevered firm, it will be 80,000 into 10% stake. So you were earning 8,000 rupees. You were earning an amount of 8,000 rupees. Then what about the step 4? Now the step 4 is, what is your earnings, or what's the amount of earnings of the investor? Earnings of investor in the levered firm. So in the levered firm, what is the amount of earnings that the investor is having? Of course, the investor is going to get 10% of PAT or PBT, 10% of PAT or PBT, and also 10% of the proportion of interest. So it's going to be like share in PAT plus share in interest. So share in PAT is going to be, PAT will be 70,000. So on that 70,000, you are having 10% stake, plus on interest of 10,000, total interest, in that also you are having 10% stake, right? Because we are having 10% stake in both equity and debt, right? 12% in equity and 10% in debt. How come? Because we have invested in equity 58,333, which is 10% of the stake. And even in debt, we are having 10% share, because it is like 20,000 out of 2 lakh. 20,000 out of 2 lakhs. So in interest as well as in the PAT, we are having a total stake of 10%. So this is going to be like 7,000, 10%, and plus 1,000, which is 8,000 itself. So what do you think? Is there any change in earnings when the investor moves from unlevered to levered firm? Is there any change in the earnings of investor when it is moving from unlevered to levered form? Is there any change? No. So earnings are same when investor moves from unlevered to levered form. Earnings are same when investor moves from unlevered to levered form, guys. Correct? So earnings are going to be same when the investors are going to move from unlevered to levered form. Okay. So would the investor be really interested in moving out his investments from unlevered to levered form? KE of levered form is 12%. That is not at all a matter of concern, Pooja, over here. Because we as an investor are getting 10% stake of the profit. So the KE may be 12%. That is used to determine the value of equity. So tax is not assumed over here. Tax is assumed to be 0. That's the underlying assumption which we are having, that the tax is 0. So earnings are same when investor moves from unlevered to levered, but investor has surplus cash of rupees 1,667 in levered entity. Okay. So it has a surplus cash of 1,667 in the levered entity. Okay. So is it beneficial? कितने टाइम लगेगा कुछ? Yes, so we are having a surplus cash of 1667. So obviously, we should be like, we can invest this 1667 somewhere. We can invest this 1667 somewhere uh, in the in some other place, and we can definitely get a higher return over there. Okay. Yes, Pooja.
Good evening, sir. Good evening, sir.
Yeah.
Uh, Sir, in this question, why we have not taken 12%, sir? How can I
We
take
are we are
10% in lever
calculating
from
here.
earning?
We are calculating here share in the profit after tax. So how much percentage are we holding? How much stake are we holding in the levered entity? 10% stake, right?
Yes, sir.
So whatever is the profit that we are having, which is 70,000. So that's 70,000 into
Oh,
10%. That is only going to be considered.
okay, okay, sir.
Okay. Okay. So, but it has obviously led to a surplus cash in the levered entity. So when you have a surplus cash of 1667 in the levered entity, investor is having this surplus cash of 1667 in the levered entity. Uh, now, of course, he can invest it somewhere else and get higher profits out of it. Now, the point is, uh, will the investor move from unlevered to levered? Yes. Investor will definitely move from unlevered to levered. Okay. Investor can move from unlevered to levered because it results in a higher surplus cash flow. Now, what is going to happen when the investor moves from unlevered entity to levered entity? What's going to happen when investor is going to move from unlevered to unlevered entity? The value of the firm is going to decline, and value of the unlevered firm is going to decline because people are going to sell the unlevered, and value of levered entity is going to increase. And this is going to continue for how long? This is going to continue for how long, guys? This will continue till both the values are equal. Till both the values are equal. Right, guys? So this is your what do you say, Modigliani-Miller arbitrage model, wherein the investor is moving from unlevered form to levered form. Investor is moving from unlevered form to levered form. Now, we can definitely think of another scenario wherein the investor is going to move from levered to unlevered. Okay, so investor is going to move from levered to unlevered. Let's take one of such example. I'll just take this format. let us say EBIT is 50,000 for both levered and unlevered. Interest which is being paid for unlevered, let's say it is nothing, and obviously in case of levered you're having it as, let's say, 5,000. Okay, and PAT is of course coming out to be this as 50,000 and this is 45,000. Of course the value of debt over here is 1 lakh. Okay, now let us look at a situation in which let's say here K is 10% and here K is 11%. So value of equity is going to be so 50,000 divided by 10%, it is 5 lakh, and then 45,000 divided by 11%, it is 4 lakh 9,091. And then the value of debt is nothing over here. So when we look at the values, here the value of firm is 5 lakh and here it is 5 lakh 9,091. 5 lakh 9,091. So what would action an arbitrager take when it comes to unlevered and levered? When it comes to unlevered and levered, what will be the action an arbitrager is going to take? Arbitrager is going to, can I say, buy the unlevered entity, right? And sell the levered entity. So this is going to be undervalued and this is going to be overvalued. Okay, so let us see how is this going to create an arbitrage opportunity. So we have, like, let's say step number 1. So step number 1 is we will look at, let's say, sell 10% stake in shares of levered firm. So we're going to sell 10% stake in shares of the levered firm. Right, so we're going to sell 10% stake in the shares of the levered firm. Can you tell me what will be the value that we are going to realize? It is 4,09,091 into 10%. So we'll be getting what? 40,909. Sell 10% stake in shares of levered firm is 40,909, right? We're going to sell 10% stake in the shares of the levered firm, which we're going to fetch us 40,909. But when we are going to make an investment in the unlevered firm, is the risk same as your investment in the levered firm? Is the risk same as that in case of a levered firm? No. Because in the levered firm, if your investment was 40,909, there was a loan on the levered firm to the tune of, can I say 10,000? There was a loan on the levered firm to the tune of, can I say 10,000? Right? So in step number 2, I'll say invest. In step number 2, we will say borrow 10% of uh, borrow 10% of loan amount of levered firm to match risk of investment in, so whatever, to match the risk of investment as it was earlier. So we borrowed 10% of the loan amount of the levered firm to match the risk of the investment as it was earlier. So borrowed 10% of the loan amount of the levered firm to match risk of investment as it was earlier. Right. So like when you had an investment of 40,909, you were also exposed to a risk of 10%, right? So this is going to be 1 lakh into 10%. So 1 lakh into 10% will be 10,000. So total funds available is how much now? What is the amount of total funds available? What's the amount of total funds that's available? 40,909 plus 10,000, can I say? Because we also invested, we also borrowing this 10,000. So we received this 10,000, right? We got 40,909 by selling the shares. Plus we also borrowed a lakh rupees, right? So we also borrowed 1 lakh rupees. Sorry, we borrowed 1 lakh into 10% basically. That's going to be 10,000. So we borrowed an amount of 10,000. So total funds which are available is going to be 40,909 plus 10,000. 40,909 plus 10,000, which is going to be 50,909. So total funds which are available is 40,909 plus 10,000, which is 50,909. Okay. So total funds which are available with us is going to be 50,909, guys. So this is the amount of money that we are having, and we are going to invest this 50,909. We are going to invest 50,909 in the shares of the unlevered firm. So we will invest 50,909 in shares of unlevered firm. right? So we will invest this 50,909 in the shares of unlevered firm. And against this investment, what is the percentage ownership? Percentage ownership acquired in unlevered firm. Because remember, in unlevered firm, the total value of the firm was 5 lakh. So from this 5 lakh, you have got 50,909 as an investment. So how much percentage ownership are we having, guys? How much percentage ownership are we having? How much percentage ownership are we having, guys? 50,909 divided by 5 lakh. Because total value of the unlevered firm is 5 lakh and we are investing 50,909. So we are having how much stake, guys? 10.18%. Okay. Step number 4, we calculate what is the earnings of investor when invested in. Earnings of investor when invested in. So what is going to be the amount of earnings of investor when invested in the levered firm? So in the levered firm, you are having 10% stake in the profit. So 10% stake in the profit means 10% of 45,000, which is 4,500. So earnings of investor when invested in a levered firm is 10% of 45,000, which is 4,500. Okay. So earnings of investor when invested in levered firm is going to be 4,500. In case of step 5, we will say what is the earnings of investor when in unlevered firm? Because remember, in unlevered firm, we are not having 10%, we are having 10.18% as stake. So 10.18% of profit of 50,000. So how much is the profit? 10.18% of 50,000. What's the number, guys? 10.18% of 50,000. 10.18% of 50,000. 5090. Okay. Okay. But can I take this entire money home? Can the investor get this entire money? Can the investor get this entire money? No? No. So where would this money be used then? Where would this money be used, guys? 5,090. If we can't take the entire earnings of the investor, where would interest we need to be paid from this, right? So we'll have to pay less interest. So interest is going to be how much? We are going to borrow at what rate of interest? Interest is 5%, and we have borrowed how much? We have borrowed 10,000, right? We borrowed 10,000. So on 10,000, 5% is the interest. So interest is going to be 10,000 into 5%, which is 500. So that's 4,590. 4,590. So earnings of investor is 5,090. Interest is 500. So that's 4,590. Right? So this is 4590 and 4590 is the earnings of, or this is your net earnings of investor. What was his income earlier? 4,500. Now you have a income of 4590. So is there an increase in the earning of investor? Increase in earnings is obviously of 40, right? And this 40, obviously it is of 90. So this 90 increase in earnings, 90 increase in earnings is not arrived at by taking some additional risk. In fact, the risk remains the same. The risk remains the same, right? So your risk remains the same, and what differs, increase in earnings is 90, so the risk remains the same, and what differs is the amount of the investment remains the same, amount of investment remains the same. Increase in earnings is going to be 90, so 90 is the additional income that you're going to have, right? So we are going to have an additional income of 90. Okay, so we're going to have an additional income of 90 without an additional investment. Rather, the risk also remains the same, guys. So increase in earnings is going to be 90. So will the investor switch from levered to unlevered firm? Will the investor switch from levered to unlevered firm? Yes, because he's having a net income of 90 without any increase in the risk. And by till what time is this arbitrage going to be undertaken? This arbitrage process is going to be undertaken till what time, guys? This arbitrage process is going to be undertaken till what time? Till the value of both the entities are remaining same, right? Till the time we get the value of both the entities remaining the same. Okay, so this is your again arbitrage model, and both of them, arbitrage as well as normal model also, they were all targeting the same aspect, that the value of the entity is going to remain same irrespective whether the company has a debt or company doesn't have a debt. Irrespective of company has a debt or company doesn't have a debt. Right, guys? Okay. How 5% is arrived? 5% is given, guys. Interest rate is given 5%, right? Interest rate is given as 5%. Okay. Won't the investor having a stake in debt also in a levered firm side? No, you are taking an investor from equity point of view only. How the risk remains the same, because earlier when you were invested in the levered entity, there was an indirect loan on it. And when you have become now an unlevered entity, you have taken loan on your own. So earlier there was a loan of 10,000 on the company, because if the company fails to repay the debt, your capital is going to be at stake. But now when you switch to unlevered, you take the loan on yourself. So basically the loan is still remaining. Earlier it was with the company, now it is with you. Okay, fine. I will clear. So this is your model, guys. Now, when we have this model, with this, we are completing the capital structure, guys. So capital structure theory, we have done the capital structure problem, and also capital structure theory is now complete. So with this, capital structure chapter comes to an end, and we have to start with the next chapter, which is called as the leverages. Okay, so we'll have to start with the next chapter, which is called as the leverages later on. But right now, Yeah, I hope this model, both the things are getting correct, guys. Both of them are correct. Model. Are we clear, everyone? Yeah. Okay. So we had like theories of relevance, theories of irrelevance. There were certain section of theories which were of the opinion that capital structure remains the same. Some were saying that a capital structure will be different. So you have seen what justification they are providing it. Okay. So they are providing it with certain degree of justification, and that justification is obviously taken into account when we are uh, looking at what is going to be the earnings of the investor when it was from levered to unlevered, right? So either it will be, you'll having like same earnings with surplus cash, or you will have different earnings or increased earnings with same investment. So either ways, you have that arbitrage advantage. Okay, guys. Fine. So with this, we are completing the capital structure chapter. Now we have to start with the topic of leverages. But the topic of leverages, we will start after a break, because since we're going to start with a new topic, let's just take a small break in between, guys. Okay, so we will be starting with the last topic of our series of discussion, which is called as the leverages. Okay, let's take a break, and then after break, we will be starting with this leverages, guys. So let's take a break, guys. Yeah. Okay. Asking the different formula for calculating cost of equity and WACC of levered firm with a formula. There are different formula. Yeah, you can use whichever is appropriately available. Let's go for leverages. So leverages. Have you ever heard this word lever, guys? Have you come across this word lever anytime? Have you come across this word lever anytime, guys? Yes. So this is something you might have learned in physics, lever. Right, guys? Yeah. So in physics, you might have learned something called as lever. And can you give me an example of lever? Example of this word lever. It could be like, a bottle opener. Okay. Or it could be an example of seesaw. Right. So these are some of the examples of levers. Now, what is the use of these levers, guys? What is a lever? What is the use of this, by the way? Can I say in each of these levers or examples, can we say they make they make our tough tasks easier, or they make the tough tasks easier, or we can say in them with less efforts we can get more results. So with less efforts we can get more results. Okay, so we can take with levers they make our tough tasks easier, and also with less efforts we can get more results. With lesser efforts we can get more results. So something of that sort happens in finance also, that you put less efforts but you get greater results. You put less efforts but you get greater results. Let's try to understand this with an example. Let me just put up an income statement in front of you. We have units, then we have sale price per unit and variable cost per unit. So let's say you're selling 10,000 units with a sale price of rupees 100 each and variable cost is rupees 60 each. Okay, so let me prepare the income statement. We start with sales less variable cost, which will give us contribution less fixed cost, which is going to provide us with EBIT. So sales less variable cost, contribution less fixed cost will give us EBIT. From that, we are going to subtract the interest. Then we have PBT. And then we subtract the tax. And we get PAT. Okay. Divided by number of equity shares, we get the EPS number. So let's try to prepare this entire income statement. So sales is 10,000 into 100, which is 10 lakh. How much is going to be the variable cost, guys? What will be the amount of variable cost? What will be the amount of variable cost? 6 lakh, right? Because 60,000 into 60 into 10,000. So variable cost is 6 lakh. Contribution will be 4 lakh. Okay. Let's say fixed cost is 1 lakh. So what is EBIT then? Earnings before interest and tax is going to be 3 lakh. So interest is EBIT is 3 lakh, and let's say you're paying an interest of 50,000. So PBT will be 2 lakh 50,000. Let us say tax at the rate of 20%. We have the amount of tax at the rate of 20% is, let's say, 50,000. We get the PAT of 2 lakh. Number of equity shares is 10,000, and earnings per share is going to be 2 lakh divided by 10,000, which is rupees 20 per share. Right? This is your income statement that we have. Right, guys? From sales to EPS, this is what the income statement we have. Right? Now, let us say a situation wherein I'm saying that the units that you're selling is increasing by 10%. Units that you're selling is increasing by 10%. Okay. The units that you're selling is, let's say, it is increasing by 10%. So what will be the amount of units? So this is 11,000. Okay. Now with this unit of 11,000, can you prepare the entire income statement? Can you prepare the income statement? Yeah. Can you prepare the income statement, guys? Yeah. Okay. Go ahead, guys. Prepare the income statement. Okay. So the selling price is That's going to remain same 100. Variable cost is also going to be 60, but the sale value is now going to be 11 lakh. Variable cost will be 6 lakh 60,000. So the contribution is 4 lakh 40,000. Fixed cost is 1 lakh, and this is 3 lakh 40,000. Interest payment that is happening is 50,000. So we have the profit before tax as 2,90,000. Now on this 20% tax rate is going to be 58,000. So what will be the PAT? 23 lakh. Sorry, 2,32,000. Number of equity shares is 10,000, and your EPS is 23.2. Right, guys? So EPS is 23.2. So what is the EPS number, guys? I mean, EPS is increased from 20 to 23.2. EPS has increased from 20 to 23.2. So one important aspect that I want you to calculate is just calculate by what percentage your sales has increased, by what percentage your EBIT has increased, by what percentage your EPS has changed, and of course by what percentage your PAT and PBT has increased. What is the percentage change in sales? It is of course 10%. What is the percentage change in EBIT, guys? How much is the percentage change in EBIT? The percentage change in EBIT is 40,000 divided by Okay, so increase in the EBIT is 40,000 divided by 13.33%. What is the change in PBT? 40,000 divided by 2 lakh 50,000, which is 16%. Okay, and what's the change in PAT? That is 16%, and even this is done in 16%. Okay, so are we observing some sort of lever activity over here? Your units are changing by 10%. Basically, sales is changing by 10%. What is the percentage by which EBIT is changing? Is 13.33%. So the increase in percentage change in EBIT that we observe is what we call as the operating leverage. So this aspect is like if I ask you what is the percentage change in EBIT, this EBIT is operating income. Divided by percentage change in sales. So if you look at percentage change in EBIT, that is 13.33%. Divided by percentage change in sales, it was 10%. So EBIT is actually not same sensitive as the change in sales, right? So change in EBIT upon change in sales, if you look, it is 1.33 times less, right? Or I can simply say this particular number is what we call as the operating leverage. This is what we call it as the operating leverage. So operating leverage is simply going to tell us for 1% change in sales, what percentage change can be observed in operating income, which is EBIT. Okay, so having operating leverage is going to maximize the operating income when there is a change in the sales value. Same way,
सीरियस बात करो जी और सीरियस बात करो मजाक ना करो मजाक करो जो चीज मांगे करो
Some issue with the camera or the network. Okay. So operating leverage is the percentage change in EBIT that we observe for 1% change in the sales. Now, higher the operating leverage, higher is the risk that the entity is undertaking, guys. So similarly, we may also have financial leverage. Financial leverage is calculated as percentage change in EPS due to a percentage change in EBIT. Okay. So percentage change in EPS due to a percentage change in EBIT. So what is the percentage change in EPS that you are observing? 16% upon the percentage change in EBIT was, guys, 13.33%. So what is this number? 16 divided by 13.33. This is 1.2 times. So how do we interpret this number of 1.2 times? We can interpret this number as for 1% change in EBIT, there will be 1.2 percentage change in EPS, right? So basically, you're going to get 20% extra increase in EPS as compared to EBIT, guys. Okay. Now, operating and financial leverage, we can actually combine both of them. And call that as a combined leverage. So combined leverage is calculated as what is the final effect in the EPS for a given percentage change in sales. So percentage change in EPS was 16%. And what was the change in sales that we observed, guys? It was 10%, right? So this is going to be 1.6 times. So here we can say that for 1% change in sales, there will be 1.6% change in EPS. Okay. So when you look at the operating leverage, if your operating leverage is higher, it means operating risk is higher. If your financial leverage is higher, your financing risk is higher. And overall, the risk of the company can be measured by the term of combined leverage. Now, why do we call it as a risk? Because if there is an increase in the sales, of course, your EPS and EBIT and every number is increasing. If there is a decrease in sales, so EPS is also going to decrease drastically, right? Because for 10% increase in sales, you will find 16% increase in the EPS, right? So this was like 1.6 being the operating, 1.6 being the combined leverage. But when we look at the other part, if there is a decrease in sales, you'll find that the EPS is also decreasing by the same higher magnitude. Okay. So therefore, we say that leverages are a measure of risk. Now, we see that operating leverage we see that it is percentage change in EBIT upon percentage change in sales. Now, how do we calculate the percentage changes, guys? Percentage changes can be computed as new EBIT minus old EBIT upon old EBIT, the whole thing divided by whatever is the percentage change in sales, guys. You can observe that same percentage change is happening even in the contribution. That same percentage change is happening even in the contribution. So I can say the same formula can be replicated as percentage change in EBIT upon percentage change in contribution. Percentage change in contribution can be computed as C1 minus C0 upon C0. This can be further replaced as E0 upon C0 multiplied by this can be stated as C0 upon E0 multiplied by E1 minus E0 upon C1 minus C0, which is difference in EBIT and contribution. So just look at the difference in contribution and EBIT, guys. What do you observe? What is the amount by which contribution and EBIT is changing? Both of them are changing by 40,000, right? Yes. So of course, if they're changing both of them by 40,000, I can cancel out this part and I can say operating leverage. Shortcut formula is C0 upon E0, which is nothing but contribution upon EBIT. So this is the shortcut formula for operating leverage. Financial leverage, the formula is EBIT upon PBT, the shortcut formula. Well, if we apply this contribution upon EBIT formula, we have the contribution as 4 lakh upon EBIT, 4 lakh upon 3 lakh. Which is 1.33, which is matching with what we have got. Financial leverage, it's EBIT upon PBT. So EBIT is 3 lakh divided by 2 lakh 50. 3 lakh divided by 2 lakh 50,000, which is 1.2 times. Combined leverage, the shortcut formula, guys, is going to be contribution upon PBT, which is 4 lakh upon 2 lakh 50,000. So 4 divided by 2.5, which is 1.6. You can also say combined leverage is operating leverage into financial leverage. Okay. So these are the some shortcut formula to calculate operating, financial, and combined leverage, guys. Now it's time for some MCQs. I'll just show you some MCQs on the screen to solve. Just give me a moment. What's the answer for first one? A company sells a single product for rupees 50 per unit. Variable cost is 30 per unit. Fixed operating cost is 2 lakh per unit. Current sales volume is 20,000 units. What is the degree of operating leverage at this sales level? So you want to calculate the operating leverage. Calculate and let me know what's the value. So first we need to get the amount of contribution. So the contribution will be 50 minus 30, which is a contribution per unit, into 20,000 units. What is this answer is? Last one. Combined leverage to be calculated over here. Contribution, Acha. Contribution is 6 lakh less fixed cost. This is 3 lakh. So we get the EBIT value. EBIT is 3 lakh. And then we have the interest figure as 50,000. So PBT finally we have 2 lakh 50. So what's the combined leverage, guys? The combined leverage is contribution upon PBT, which is 2.4. So option C is the correct one. Did we all get it right? Okay. Okay, so we got this fourth question also. Okay, so with that we have completed the introduction to the leverages chapter, guys. So next session, which we have on Monday, that will be the final session, when we'll be completing the chapter of leverages. Okay, with that, let's just stop here for the day, guys. See you in the next session. Bye bye, guys. Yes.